Welcome to the first episode of Moving Money and Mortgages, where I'm joined by Marc from Me Financial. Now, we've covered a lot of content in this one, from first-time buyers, deposits, bank of mum and dad, right the way through to self-employed mortgages. And we've tried to cover all the questions that we get asked on a daily basis. We do appreciate, though, that not everything will be relevant to everyone, so we've broken the video down into chapters at the bottom. If there's something specific you'd like to understand, feel free to jump straight to that chapter. But for now, I hope you enjoy.
Welcome to our first part of our series, what we've named Moving Money and Mortgages. I'm Andy Butts. I'm the founder and managing director of Miller Rose. We're joined today by Marc, who's also the founder and managing director of Me Financial Services.
Whatever title makes me look good, I don't mind.
Yeah. Perfect. I think in this series, what we want to try and do is cover off all of the basic questions and queries that come up during a mortgage, answer the big questions that do come up, and also what buyers should be asking throughout the process, buyers and sellers. So we're going to start really kind of on the novice level, aren't we, Marc, and go through some of the real basics, and then build up gradually into a bit more advanced kind of discussions over the series. Given today is the first series and the first episode, then Marc, explain to us what a mortgage it actually is and how it works.
So how I explain this to my first-time buyers is, in our business, there's a lot of jargon. You hear capital interest, all these different sort of words and everything like that. What is a mortgage? Effectively, a mortgage is a big loan that is secured on your house. So what does secured on your house mean? Basically, it just gives the right that if anything happens to the property, when you sell it, they're the first to get the money back. And that's basically all it means. It's a big loan on your house.
Okay. That's nice and simple. Then I suppose there's a bit of conversation around the term of mortgages as well. How many years can I have? That kind of stuff. Could we just break that down really simply, Marc?
Yeah. So generally speaking, there's always exceptions, but you can generally look at a 3-year mortgage up to a 40-year mortgage. There are some caveats on that. So for example, if the 40-year term would take you up to the age 124, you probably wouldn't get it. So generally people will arrange their mortgage to be sort of over their working life and over their affordability period, i.e. up to retirement. But there are some exceptions to that as well, as always.
Okay, great. In terms of, there's two general options of repaying the loan or not repaying the loan, as it might be, which are known as a repayment mortgage and an interest only. Can you just break those down for us?
Sure. You always have to pay your money back. So you can't not repay the loan, but I know what you mean. So there's two main repayment types, capital and interest, which I would suggest 90% of people are fully aware of. So your traditional mortgage. So there's two parts of your mortgage. There's the capital, which is the amount you're borrowing. So basically that's what the bank is giving you or the lender is giving you to buy the house. And there's the interest, what they're charging you for lending you that money. Basically, on a capital repayment mortgage, also known as just a repayment mortgage, your capital and your interest is being repaid over the full term of the loan. And generally speaking, the shorter the loan period or the shorter the mortgage term, the less interest you pay. The longer the mortgage term, the more interest you pay. Now, the change to that is an interest only. So an interest only, I would suggest, certainly if you're a first-time buyer, 99.9% of the time, you wouldn't be going for an interest-only mortgage. So the capital bit that I mentioned earlier, effectively, that is being repaid from another source. It may be the sale of the property in the future. You may have a pension lump sum or something like that, or another asset you're planning to sell. And then you pay interest only on the money that they've lent you. So that's basically how it works. That's quite common on buy-to-lets more often than not, but there's certain scenarios where it would be suitable depending on the right advice for the right client.
Okay, brilliant. Then moving on to one of the biggest questions I suppose you get every day, Marc, is how much can I borrow and how is that figure arrived upon?
Sure. Okay. There's lots of noise out there about the multiples that you can borrow. Yes, the big buzzword is 4.5 to 5 times your income. That's generally what people say you can borrow. My advice to anyone buying a home is I would suggest that's like a limit that the lender would lend you. The biggest factor in what you can borrow is your affordability. So, for example, if you're a first-time buyer and you've got no other outgoings such as loans, credit cards, or even student loans are a big factor in a lot of this stuff. If you've got less outgoings going out on a monthly basis, you can generally afford more as a mortgage. So the lender will base everything on that. So if you've got a lovely Mercedes on finance for £900 a month, that will certainly impact your ability to be able to get up to that top ceiling that the lender will lend you. But a wet finger in the air, certainly with a lot of schemes at the moment, 5 times is probably a fairly decent area to start. But a good mortgage broker would work that all out for you.
Yeah. Okay. And is that the same if it was a couple buying or a husband and wife, partners, friends, same kind of multiples and lending criteria kind of apply, right?
Generally speaking, yes. But remember, if you've got two people, you've got two people's outgoings rather than one person's outgoings. But generally speaking, if you're buying as a household, it's the overall household situation that a lender wants to understand.
Yeah. I think what you've said before probably answers this, but sometimes we get queries that you've got two people, let's say they're earning the same amount of money. Let's just pluck a figure out the air, say £40,000 a year, and one comes back with a higher loan agreement in principle, let's say, than the other. Why would that be, Mark?
It's often the way, yeah. And many examples. I'll try and make it as simple as possible, but it often never is. So I would break it down as to income, first of all. So you may have a couple that, as you say, are on a household. Let's say they're on 40,000 each, exactly the same pay. You may get somebody's income made up of more like overtime and things like that. So some lenders will take 100% of overtime, for example. So if you're a nurse or something like that and you've got bank work, maybe they'll take 100% of that. The others may only take 60% of that. So if you have complex income situations like that, it's very common that will be a major factor of how a lender assesses how much you can borrow based on how your actual income is broken down.
Yeah.
Other things as well. So I'll give you another example. One thing that we've got that's quite common at the moment is if somebody, say, built on a credit card or something like that, they had a holiday and let's say they were going to get a bonus and they were going to pay off that credit card. Some lenders will go, okay, that's fine. You're paying off that credit card. That won't be there when you complete on the mortgage. So we will not factor that in for when you buy your home and our assessment of your affordability. Other lenders will go, well, we don't know if you're going to be able to pay that off or not. There's no guarantee. So they're either going to want to see it paid off beforehand or they'll factor that in for affordability, which is another factor. They're probably the main two things.
Is that because I suppose some lenders are just more risk averse than others and just have different criteria? Is there any standardization between them, or it's just their preferences?
There's generally a rule. If you go to your bank directly or you go to a mortgage broker would generally know how different lenders approach things based on your circumstances. They were just a couple of examples of the things that might change. But as a standard rule, you're going to get some lenders that work in that way, some lenders that work in that way. They're generally fairly similar. And it's not an exact science, but the lenders that will generally factor in your credit cards for affordability, they may lend you slightly more to counter that. So every lender will have different policies. Every lender will have a different way of approaching what they perceive as risk. It can be a bit of a minefield, Andy. So, yeah.
Yeah. I know one thing that's come up in the past, and people have asked me, and given we're in the middle of an international sporting event at the moment, sometimes online gambling has come up on people's bank statements. Again, a certain lender's kind of looking at that saying, well, you need to budget for that because there's a consistency. Or can you just say, well, I'll stop that when I get my mortgage, so don't put that into my affordability calculator?
Yeah. It's a big thing, certainly with the season on at the moment. Yeah, there's a lot of noise. Lenders don't like gambling. They don't like gambling because they just don't. They want to see that you're responsible with money and everything like that. Now, they don't mind you having the odd flutter and everything like that. But if they look at, say, 3 months bank statements and they can see an average of, say, £100, £200, £300 a month consistently every month, it's not illegal to gamble, but they would factor that in potentially as a cost, like a hobby that you've got. And that could potentially impact the affordability that you can borrow as well, just the same way as it would if you're having a car loan. Now, we've had lots of scenarios where it is a one-off flutter, for example. So, people are going crazy at the World Cup and I see all this Sky Bet going through. Other gambling sites are available. And what you'll see is there's a big chunk in one particular month. And then the previous 2 months, there was nothing. My advice will be, if things are calmer and everything's as a norm, that's what the lender's looking for. And generally that 3-month window is very important, if not 6 months, depending on the type of application. 3 months, squeaky clean, as they say, is a good idea. So if you are in the market of trying to get your agreement in principle, that'd be the big tip. Try and not go crazy if it's outside of your normal spending activities.
Yeah. Okay, great. Good advice there. I suppose if, let's say you're a first time buyer and you're thinking, right, we're going to buy a house this year within the next 3 to 6 months, what should people be preparing in terms of documents, ID, all the usual stuff that you'll get asked for when you go for your first appointment or your key fact find? What could people start gathering, and what are some of the good, useful kind of tips you'd give people in that scenario?
Yeah, just to mention on this point, we get a lot of questions about why do you need that when the lender doesn't need that. So there's two categories of the way I'd explain that. Okay, so first of all, there's what the broker needs, so what the advisor needs to be able to do a good job in terms of giving you the right advice, and then there's what the lender needs. So generally speaking, sometimes we may ask for more than the lender wants, but that's because we want to build up that big picture to give good advice. Generally speaking, we need to know who you are. So we'll need ID and address proof, income confirmation. So if you are self-employed, then it's a little bit more complicated, but generally 2 to 3 months self-employment proof, tax calculations, tax computations, something from the accountant possibly. A good broker will tell you all of that stuff and lay it out for you. But self-employed income proof, if you're employed, slightly easier. 3 months pay slips is generally the norm. If you have lots of bonuses or overtime, P60s would be a good idea to get those in order. Bank statements. So generally speaking, we need 3 months bank statements. And that's for every account that you've got money going in and money going out of, generally speaking. So lenders want to know what's all the stuff that's going in, all the stuff that's going out.
Okay. Brilliant. If we move then on to the next phase of the process, then I suppose in terms of the deposit. So generally, again, maybe if we break this down for first time buyer initially, what kind of deposit thresholds are out there in the market? What do people need to know about the deposit structures?
So the pretty simple, straightforward one is a 5% minimum is normally the thing that's batted around. So 5% minimum. That's not quite the same nowadays. There's lots of schemes that are coming out that are a bit more accessible, helping first time buyers and people get on the ladder. How it generally works is the smaller your deposit, the higher the interest rate will be. And I suppose the more scrutiny the lender may apply in terms of your affordability, because there's not that equity in the house to give them that bit of comfort that, is an easy way to say it. Yeah. And then the bigger the deposit, the more you can potentially borrow. The bigger the deposit, the better the interest rate. And generally speaking, the more you can potentially borrow, because you'll hit different criteria in terms of risk for the lender. It's not always the same, but that's generally how it works. Now, talking about those sort of specialist areas, so there are some lenders out there that do zero deposit, so 100% mortgages. So that's you putting, if you're buying a house for 200,000, you're borrowing 200,000. Now, they're getting more and more common. There's a lot of schemes, for example, where as long as you're renting for a period of time, like the Skipton deal, they would average out what you're paying on rent, and that would sort of go towards them understanding your affordability from that position. But also there are lenders out there now that are on the high street that will generally look at a minimum of, say, 2% deposit as well, which hopefully makes things a bit more accessible. My only thing is, going based on your previous question about what do you do to prep for that, you need really good, squeaky clean credit. So make sure you pay all your payments monthly. Try not to miss anything. Your mobile phone. It's always a really great idea to get a copy of your credit report if you can first, and not just a nice sort of glossy score that you get on these, My Score and all those sorts of things. Get your proper report. It's a statutory report that you can get. We can help you understand how to get one, and it'll have all of your payment history on it, so we know what you're walking into before you go. You'll be surprised how many people will have a parking ticket that they didn't even know they had. And that just at the last possible minute throws you out, and you were like, I didn't even know I was in that car park. I didn't even know it was raised. So it's always a great bit of advice to make sure you know exactly what position you're in before you're going ahead, certainly when you're looking for a specialist scheme with a small deposit.
Yeah, I think there's a lot of people, especially with all the car lease schemes now and stuff, they don't sometimes, these parking fines, particularly for the private car parks, sometimes don't arrive in time or get lost. So yeah, I've seen a lot of that where people have got parking fines with their names on it that they don't even know about. Or the other one is mobile phone bills. Seems the most regular one that comes up of bad debt, I think, mobile phone bills. So if somebody did say somebody missed a payment or it was fairly minimal, didn't end up at a CCJ or something, what's the kind of workout period? How long do you need to give it before a lender will look at them again, or does it just affect maybe their affordability?
Yeah, I would say it's a sliding scale. So lenders generally will have a tolerance, like I said at the very beginning, they'll have a tolerance of what they're prepared to accept. So if there is any tolerance, I suppose the entry level of tolerance is, the odd mobile phone thing, the status as it's called. So if you were looking at your credit report and it's got a 1 on it, that means you're 1 month behind. Generally speaking, if it's below £250 maybe, or the odd blip that's never happened, most lenders will overlook it. It'll be down to your overall scoring profile. So for example, if you were apart from that, squeaky clean, good job, been in your job a long time, a consistent deposit, it will generally be okay. They'll be generally sort of mainstream will still be open to you. But there are sort of more specialist lenders and maybe smaller building societies that say, well, actually, as long as it's not more than £500 or even £1,000 under the right circumstances, we're okay. Then the next parameter, if you like, is how long ago it was. So generally, if it was more than a year ago, maybe even 6 months with some lenders, some things get ignored. If it's over 2 to 3 years, that's also good. There's a sliding scale based on how much it was and what it was. Yeah, if it's a little blip or anything like that, don't lose sleep over it necessarily. There are generally available options.
Yeah. Okay. Brilliant. And then obviously while we're in the topic of deposits, the most popular form of deposit these days that we see is Bank of Mum and Dad, I think. I think you'll probably tell us the stat, but I think there's a high percentage of first-time buyers that are utilising that Bank of Mum and Dad gifted deposits, as technically it's known. Just talk us through that, Mark, and what the options are for the parents, and what the options are then, I suppose, for the first-time buyers that might be utilising that gift.
Yeah. So a gifted deposit generally has to be from a direct family member, and it generally has to be, and I'm very much talking in generals at the moment, so I don't apologize for that. There's always a change to it, but it generally has to be from a direct family member and an outright gift. So if there's any stipulations that your mum says to you or your dad says to you, listen, I want that back in 15 years or in 10 years or in 5 years or whatever the case might be, it has to generally be an outright gift. So there's no reservation of them getting the money back. That's your sort of entry point. Now, there are other lenders that are okay with that, depending on the circumstances. So we speak to a lot of first-time buyers that, parents might be saying, well, I'll tell you what, you can have your inheritance now. We'll get you on the ladder. It's a great new job that you've got. We want you to have your own home, or they might have had a new family on the way or something like that. But they say, we're going to give you this, but when you get that bonus, we'll ask for it back. So there are lenders out there that would consider those arrangements as well. But generally speaking, your 5% deposit that your parents are gifting you, as long as it's an outright gift, it's fine. Now, what does the lender need to confirm that is the big question. So normally a gifted deposit letter. So the lender may have their own template that needs to be filled in, and then the parents will sign that to say that that's the scenario. Alternatively, a letter that we normally help clients draft a letter to say it's an outright gift and they've got no right on the property or anything like that. Generally speaking, your mum and dad are lovely though. They'll give you the money, no problem at all. If there are more complicated scenarios, some will factor for that.
Yeah, we might be going a bit deep into this, but I've heard of some maybe putting a first charge on or a second charge after the lender. Is that possible? Or again, is that certain lenders will be happy with that, others won't?
Yeah, it's slightly less mainstream. So some lenders will do that, yeah. It's not out of the question. I think Santander are slightly flexible arrangements on that, not to say that they're right for everybody, but depending on the scenario, some will consider that, but things change all the time. I think as well, lenders do know nowadays that there are complex, first-time buyers are struggling to get on the ladder, and they want to try and make ways to help people get on the ladder and things like that.
Yeah. So the note is, be nice to your mum and dad.
Especially the 3 months before you buy. Treat them like a credit report.
Then lastly, I suppose on deposits and type of mortgages, the other kind of affordable route is either affordable homes or shared ownership, where you're either buying a percentage of the property and then the other half or 30%, let's say, is retained by a housing association, or you might be buying a home that is what we say is kind of marked as an affordable home and will always be an affordable home. So will always be, let's just say in this instance, 30% below market value. And when that person buys the property and when they sell it, let's just say in 5 years' time, they have to sell it again to that same criteria of a first-time buyer with income thresholds. And it has to be at 30% below market value. Again, coming on to lenders, are there specific lenders that do and don't like that? Maybe if you could just elaborate on the shared ownership, because it's probably the more common one.
Yeah, so that's the new home scheme. Is that what it's called?
Yeah, so the new home scheme is where the property will always be,
that one.
let's just say, below market value. That's the latest government version. Then the other option is that they do shared ownership, where they can then staircase more later if they want to sell their share of the property later down the line.
Yeah, exactly. So that's the new home scheme, basically. As you say, that discount follows the property around and it helps key people get on the ladder. That's basically how it works. So that's getting a little bit more popular now. There seems to be a lot more lenders coming out. I think they're getting used to that scheme. It's not been around too much now. There's certainly a couple more lenders where that's available. Affordability is pretty much based in the same way, because you're effectively buying a smaller bit of it, but you'll never own the bigger slice of the pie. But then who cares? You're on the ladder. Yeah. When you sell that, that'll go to the next person for the same sort of arrangement. It's a scheme that hopefully more and more people will take advantage of.
Yeah.
With reference to shared ownership, as you say, yes, there'll be a housing association or another party that you pay rent on. That's the major thing that people need to consider. And your proportion of the property that you buy, let's say you buy 40% of the property, as before, the rents to the housing association is factored in for affordability. But because you own less of the property, you could potentially need to borrow less money towards it. Now, your deposit goes towards part of the share that you're buying. So you'll have a share to value number. A lot of lenders will have an entry point of say 5% deposit towards that bit you're buying. So 5% of 40 is a lot less than 5% of 100% of the house a lot of the time as well. Well, most of the time, all of the time. That's effectively how it works. My advice always is when you're looking at a shared ownership property is though, depending on your circumstances, you need to know what the rent is straight away. So hopefully, speaking to an agent like yourself, what's the rent? And then we can backwork the affordability from that point of view. And that's effectively how it works. So for a lot of people, that's another way to get on the ladder. There are options as well with shared ownership called staircasing. So you could come in at an entry level, say 30%. And then as you save up money, you can buy bigger chunks, normally in 10% chunks as you go along as well. For a lot of people, it's a good entrance into the property market as well.
Yeah. And I think from our side as agents, we're seeing a lot more affordable homes come into the market because previously developers were able to pay off that allocation through a Section 106 or a SIL payment. Whereas now the government and the local councils are really pushing them to deliver the affordable housing rather than just pay it off. So let's say there's a development's of, let's just say for argument's sake, it's like 100 homes. You'll probably find that there'll be anywhere from 10 to 30% of that scheme, of that development will be affordable. So I think you are seeing a lot more affordable homes come to the market through schemes such as the First Home Scheme. Therefore, I suppose from our point of view, we just hope that the lenders are starting to see that. And, you don't have to go to a specialist lender, I assume, these days for that kind of stuff. It's pretty mainstream.
Yeah, generally speaking, the more mainstream lenders, Skipton's very good at this sort of stuff. And I'm sure they're on the shortlist for that as well, But mainstream lenders want to support people buying homes and have these sort of schemes available. So 100% there needs to be more homes. We all know there needs to be more homes and there needs to be more help getting people onto the ladder. And lenders are hopefully following suit with that as well.
So Mark, talk to us a little bit about the application process, because I think a lot of people don't understand what's actually involved, the steps, especially if you've not been through it before. It's quite a complex process. But if I was turning up to you today and said, look, we're thinking of buying a house in the next 3 months, how do we get what's, again, busting a bit of the jargon? We've got AIPs, we've got DIPs, we've got multiple other acronyms, I'm sure. So talk us through what those are, what's the value of them for a buyer going to look at kind of properties, and I think maybe helping them negotiate on properties as well, obviously proving their status, etc. And then maybe the steps once they've found a property, what kind of steps they can expect to go through.
Yeah, it's always chicken and egg with this stuff. So, do you go and look for properties and see what sort of thing you're going to be wanting to buy, or do you go to a mortgage broker and find out what you can borrow? I'm biased, but I think you need to find out what you're going to borrow first. You might be surprised to borrow more than you actually think. So you're going to be looking at different property, different area, close to your job, all those sorts of things that, you guys will help them understand. So where do we start? So our first step really would be an initial conversation, just a chat, go through what are you looking for, why are you looking to do it, get an understanding of what you know, what you don't know, and sort of a grounding session in terms of that first conversation. Then we'll gather a load of documents from you, which I mentioned in another video, all of your proof of income and ID and all those sorts of things. And we'll give you a full list of everything there. Then after that, we'll talk about what's available for you. So we'll do an affordability check at that stage, understand what your affordability is. And from there is where you've got the AIP, DIP, or the MIP, there you go, MIP. I only call it, I'm in the industry, call it DIP, it's fine. But yeah, your decision, mortgage, or agreement in principle, basically. They're all the same thing, they're just different buzzwords, basically. What that is we will take all of that information, we'll go to the lender, and we'll do a credit scored, often what's called a soft search credit score, which basically that means it won't have an adverse effect on your credit report. So don't go crazy and do loads everywhere, but that's the thing to bear in mind. And that's really the lender going, thanks for that information, Mark. Based on what you've told us, it's past credit scoring and we can consider this in principle. I've got a CIP now, consider this in principle. But That's effectively all it means. Now, a couple of things on the AIPs. People say, how long does it last for? What happens? Probably going to get a slap on the wrist for saying this. Generally speaking, it's good to know for a peace of mind. An estate agent will want it because they want to see, that you've got funding in place and everything like that. But there's been no assessment of the income proof that we've sent to the lender is actually correct, which is why our job is to make sure all of the stuff you're telling us is completely true, honest, we understand it, and this is the true position. So when we actually go to the application stage, everything's going to sail through. Because I could just say, oh, Andy, you're on 650,000 a year, which I'm sure you're not far off of that. But we could just put that on there, and then you're going to get the agreement in principle. Then, oh, no, you're not. You're only on 10. Sorry. And that's the major thing that I think people get concerned about. How long do they last as well? I would say generally 1 to 3 months. But to be honest, if you had it once, if your circumstances aren't the change, you're very likely to get it again. So if you take time to find a property, don't panic if your agreement in principle expires. As long as your circumstances are the same, it's fairly the same. So where do we go from there? Next step is, yes, Mark, that sounds like a great deal. Let's go for it. And we'll go through all the options and then we'll agree. Then we'll do the formal application. Okay, so we'll go to the lender, we'll give them all the...
This is once they found a property and agreed an offer on it, right?
Yeah. We just skip that bit of finding a home for sure. But yeah, at that stage, they're going to say yes. So you take your agreement of principle, you go to the estate agent goes, yep, we love it, no problem. You probably know this better than me, but the estate agent would generally want to know that you've got funding in place, which is what that agreement of principle is. And also your proof of your deposit. So it's not uncommon. Often we'll go, why the hell is the estate agent asking for this? It's very common, I'm afraid. You need to know that, they got the money to do it. Especially if there's 100 people bidding on the property as well, or interested in the property as well. So generally speaking, that's how that works.
Points there, just to, I suppose, elaborate on them a little bit. There's two reasons that an agent will ask you for a proof of funds. One, they've got an obligation to their client, who is the seller of the property, to make sure that the offer or the offering party is proceedable. So, it's their job to do their due diligence on the incoming party that's making the offer to make sure that offer is going to go through. And it's all, Mark's done a great job and got them an agreement in principle. The second part to that is anti-money laundering regulations. So ourselves as agents, solicitors, and I'm sure yourself as well, Mark, are all regulated by the same Anti-Money Laundering Act. Therefore, we do need to see where the money's coming from as agents. So if it's coming from gifts from parents, if it's coming from, your savings account, if it's coming from a bonus, expect to be asked those questions by the agent as well as the solicitor, because we're all regulated by the same act. So you will have to produce the same information probably a couple of times, if not 3 times. But when you are negotiating an offer, when you put an offer in, I think, like you said, Mark, a lot of people think, why is the agent asking for that? But it is legislation and regulation, and you should be asked that on every offer you place on a property.
100%. Yeah, definitely. And I always say that to people, you got to make peace with the fact that you're going to be duplicating a lot of work. So we will work for our client, you'll work for your seller. Funnily enough, the solicitor works for the lender and also the client who's buying as well. So all of those need to marry up. And to be honest, they're all going to be asking similar things. So I think we could do a whole other video on proofs of deposits and things like that. But generally speaking, everyone needs to make peace of where that deposit's come from. So after that stage, hopefully you guys will say, that's great. The vendors agreed to your offer and accepted the offer on the property. Then we go to the application stage. So we will basically package that up, update any illustrations with you if the price is slightly changed. They've had to negotiate a little bit, or maybe it's gone up the other way. Whatever the actual purchasing price is, we'll present that to the lender, make sure it all fits and everything like that. And then we'll do the full application. Generally speaking, the lender wants the stuff that we've already got. So the proof of income and all those sorts of bits and pieces. We submit that to the lender. At that stage, generally, but it may be further down the line, but generally speaking, your mainstream lenders will instruct a valuation, okay, or a survey. Now, that is probably a whole other video as well, I'm certain of it, but the bare minimum valuation that you're going to need, or the lender will need, and that's an important distinction, this is for the lender. So this is for the lender to say, if Mr. Customer is trying to buy this £200,000 house, do we think it's worth £200,000? Now, lots of people get I want to know what the valuation report came to and everything like that. It's very, very, very uncommon that a mortgage valuation will overvalue the property because they're not looking at it from a market appraisal point of view. They're looking at it from a point of if you didn't pay this back to us, could we get our money back by selling the house in a brutal way? And that's basically how it works. So if we will always urge somebody to have a more comprehensive valuation, just to make sure there's any niggles or teething problems in the property or anything like that. But that's what they'll do. Now, fingers crossed, that valuation will come back okay. The lender will then assess that, assess the documents you've got, and then hopefully at that stage, you'll get an offer. Now, in the middle of all of this, you would have instructed a solicitor. Okay, so the buyer will have a solicitor that is dealing with buying the place. Your seller will have a solicitor that's dealing with selling the place. And generally, putting it very simple, those solicitors will thrash it out and then work out exactly how that process is going to happen legally. Very, very straightforward. That's another video as well, I imagine. I'm committing myself to all these videos. So that's generally how it works. So a copy of your offer will go to the solicitor. A copy of the offer will go to the buyer, and I'll get a copy for good measure to know everything's great. And hopefully I'll have some good news, and there we go, all sorted. Yeah. After that stage, expect things to go quieter, because the solicitors will be backing and forthing and all that sort of stuff, as I mentioned earlier on. They're called inquiries. Yeah. So the inquiries are being raised. An inquiry is basically a question that your solicitor or the other side, they're asking each other questions about things to satisfy the conditions of the mortgage offer, but also stuff that you might want to know about. So, for example, is there a sewage at the bottom of my garden that is going to burst out of the ground any particular minute, or any other sort of environmental factors? So they'll be asking each other questions. Then when that's all done, as you no doubt know, hopefully both sides are happy. You choose a date, you'll pay your deposit at that stage. And then at that stage, you'll do what's called an exchange of contracts. So that's where you basically, your signed bit of paper, their signed bit of paper, you physically sign each other's. I think in the modern world, it's not quite that simple, but often it is. And then at that stage, you agree a completion time. I would say end to end, you're probably looking, depending on the chain, so how many people in that process need to buy or sell, 8 to 12 weeks. You might be cringing at that, Andy, I don't know, but 8 to 12 weeks. Sometimes it's certainly longer.
Definitely, yeah.
I've had one going for 2 years. So
the system definitely needs some reform, that's for sure. But again, another video on that, I'm sure. I suppose that one of the key questions then, in terms of, we're obviously talking about mortgages here, from the point at where you complete the application with yourself and that goes off to lender, what's the time frame you can expect for the valuation to be done, for the valuation to come back and get turned around? And if everything goes okay, go to offer, because I've seen them, you've done a mortgage for me in 48 hours, Mark, and I've seen them drag out for 6, 7, 8 weeks or more. What's the standard, I suppose, and what sometimes draws that out to elongate it, where we're talking about ones that might take 6, 7, 8 weeks?
Biggest thing I get asked, right? So as you said, we could have one case that you get the offer the same day, and we can get other cases where, like I say, it takes longer. It's all that questioning bit. But if everything was going to plan, okay, and nothing was special in terms of it being exceptionally fast as opposed to exceptionally slow, which I'll tell you why that is in a second. But if everything was going by the standard, I would say an agreement in principle, normally the same day, maybe within 2 days from the point of us submitting that agreement in principle. Same day is very common if everything goes smoothly. Same hour even, we'll key it and the computer says yes. It's literally that straightforward a lot of the time, and it's great when it is that straightforward. So same day. After that, submitting the application, I would say normally the valuation is instructed the same time, if not within 5 working days. But remember, if there's a valuation, the person that's selling the house, their calendar needs to all match up and everything like that as well. So, they have to let the valuers in and all that sort of stuff. So I would say probably you're looking at, from application to valuation, probably 2 weeks is a reasonable timescale. Anything over that would be a bit like what's going on. Once the valuation's back, it could be another 2 weeks to get to offer. So I think from 2 to 4 weeks to get to offer, you're doing fairly well. I wouldn't be panicking at that stage. Now, the change to that, where things go very, very quickly, a lot of lenders will do something called a desktop valuation. So as I said earlier, they don't necessarily care what the property's worth, as long as it's worth what you're buying it for and what they're putting a mortgage on. So often they'll use what's called a desktop or an automated valuation, where a computer looks at the properties in the local area and there's some fancy formula that works out how much that property's worth. And then it will automatically go, yeah, that's fine. We think that is worth that. Then A lot of lenders as well, in terms of speeding things up, which, a good mortgage broker would understand all these things. Some lenders will automatically verify your income now as well. So all that stuff that goes to HMRC by your national insurance number, they'll automatically verify your pay slips and everything automatically. Best feeling in the world. If you can give someone a mortgage offer within the same day or the same week, it's the best feeling in the world to someone in my job. That's why sometimes it's a lot quicker than not. Unfortunately, the whole legal process and everything still needs to happen. The fastest thing you're doing by that happening and being lucky enough for that to happen is you're moving a potential 2 to 4 week window down to a 1 week window. And I'd probably think of it like that. The rest of it's legal work and answering questions back and forward. Another important thing to mention, actually, Andy, while we're on it, is although the agreement in principle, not to say it's not worth the money it's printed on, but it's not worth the money it's printed on, the offer actually is, because your offer has actually been looked at by the lender, fully underwritten and agreed. So it's a formal offer and a formal document that says, yes, we have looked at everything now and we're happy to do this. Now that will last anywhere from 3 to 6 months, depending on the lender. And you have got a time scale to work towards that.
Yeah. Okay. And once the offer is issued, is there any, let's say that, there's another 2 months involved with the conveyancing process with the solicitors. Is there any way that lender can withdraw that product if their rates were to change or anything like that? Or is that offer valid for those 3 months? And if anything changes after that, you might have a bit of a trouble kind of extending it. But is there any way that they can withdraw it other than circumstances changing on your side?
Not really then. That was the one thing I was going to say. So if they've offered it to you and everything's the same and nothing's changed or anything like that, then it's extremely unlikely they'll withdraw it. Just on the point, though, of circumstances changing, one of the most common things that people do is they get their mortgage offer. Then they go, it's great. We've got the money now. I'm going to go out and get that sofa on finance. I'm going to go out and get I'm going to go and buy that car that I've been putting off, or I'm going to go crazy because the football's on and I'm going to gamble like mad, just like you said earlier. Yeah. But the lender has the right to review the case, and they will often do it again before offer, or if they're going to do it even before completion and releasing of the funds. At the end of the day, they're going to give you, the best part of 150 to 200,000 plus. So they have every right to relook at the information, relook at your credit history and your credit score and rescore you and make sure your position is exactly the same. Whenever there's been a problem and the offer has been pulled, it's normally for that exact reason. You've gone and upgraded your car and they didn't know about it or something like that. And so apart from that, it happens on a nice way as well. So if the rates drop, which is happening quite a lot at the moment,
yes,
depending on your broker, if they're nice, if we spot that the rates have dropped and there's a better deal available for you, lenders are generally quite happy to allow you to choose a new product if the rates have dropped. They won't necessarily extend your offer time because it has to expire at some time, but they will change that rate that's attached to that offer. And hopefully your monthly payments are a little bit lower.
Okay. So same lender, better rate, better product, and they'll still use the same initial valuation they did. Just be an update on the offer and hopefully.
Exactly right. Yeah. So the valuation lasts a certain amount of time. So that's the thing that often drives how long the offer will last for, because you can't still re-offer on a property that hasn't been valued for 2 years. So if the offer does expire for any particular reason, it's not the end of the world. You just may need to reapproach that lender and check that your circumstances are all the same. It does happen, unfortunately.
Okay, cool. Very good. I suppose next section then is we've touched on it briefly there, but interest rates. A lot of people get quite hooked up on interest rates, whether it's going to go up by 0.5% or drop by 0.5% this year. Who knows? But I suppose a couple of questions around how to tell whether the rate is actually a good and competitive rate in the market. An explanation of things, mortgage products we hear about that are fixed rates, variables, trackers. Maybe give us a bit of an insight into the different products that are out there that purchaser might be presented with.
Yeah. Okay. So you give me a lot to unpack there, but I'll try and take it one at a time. So, well, let's talk about the types of rates first then. Okay. You've got fixed rates, you've got variable rates, you've got tracker rates, which some would argue are within that space of variable rates. They're generally the three. Okay. And it's how long that's for as well. Let's look at fixed rate, for example. The most normal thing, I would say the most common thing, which wouldn't affect your advice, but the most common thing is a lot of first-time buyers especially will say, right now, I want to know exactly what I'm paying for a period of time. Our advice will be based on that. And the product that we recommend will be based on that. So if you took a fixed rate mortgage, okay, and let's say you took that over 35 years, then you have an initial period of that rate. So we would give you a quotation and say, right, your mortgage is going to be £900 a month for the next 2 years. Then after that, when that initial period ends, you'll go up to what's called a standard variable rate, or the standard pants rate. It's the bog standard rate that you drop onto. Hopefully you'll never be on that, because at that stage you either choose to another lender, which is called a remortgage, which we could certainly help with. Alternatively, you stay with the same lender and choose another deal. And that's called a product transfer or a rate switch or a rate renewal, depending on the lender. Okay. And the advice based on which one you do is obviously based on your circumstances at the time. So I'll give you an example. If somebody said to me, I've got a real live example, actually, I'm dealing with a graduate at the moment, and they're on a graduate scheme where they're on a 30 odd £1,000 salary at the moment. But when they graduate in 2 years' time, they're going to have a salary bump. So at the moment, they can afford, say, £1,000 a month. But then when they graduate and they get their big salary bump, they're going to go, well, I really want to bring that mortgage term down after that 2-year fix. So our advice would be, well, if you want that flexibility, you have your peace of mind for that initial 2 years. And after that, we look at a different deal, and we look at either shortening the mortgage term or, going interest only. I very much doubt you'd do that. That'd be the advice. But whatever the circumstances are at the time, we'll give you advice based on what your circumstances are then. So if you can afford to pay more, you can do that. A lot of lenders allow you to overpay as well. That's another important thing. So generally 10 to 20%, you can overpay without breaking that deal. But that's the main thing. If you break your deal within that initial period, you'll have an early repayment charge, which is often 1 to 5%, depending on the type of deal you've got. So trackers and variable, we just clump them up at the same time because we don't need to really grind them all down. There's a lot of things about the Bank of England base rate, going up or dropping at the moment and things like that. A tracker deal works in the same principle. That initial period, you'll have a discounted deal or a lower deal, and it will track base rate, or it'll be a discount on the lender's standard variable rate, whatever the scenario is, but you'll have a variable mortgage, but hopefully it will be lower than what the standard variable is. And then within that 2 years period, once again, have your circumstances changed? Are we going to do, are we going to look at different options or anything like that? The major reason you would choose variable over a fixed is generally if that variable was lower and you were confident that you wanted the ability for your rate to reduce if interest rates drop. But our advice is always, what's available on a fixed rate, what's available on a variable rate, and how comfortable are you of what's going to happen to the market and how much flexibility you want. Your mortgage broker, no matter what they might say, we're not economists. So I've got a mortgage that's coming to the end of a deal now. Who knows what's going to happen? One crazy tweet from somebody out there, it's going to change the market all completely. Anything could happen. The most important thing is what that person or what that client, what the impact would be if a change happened that they weren't ready for.
Yeah.
What other things were we going to talk about at this point?
I think understanding what is a good rate in the market and what kind of research can people do, or what questions maybe should they ask the broker at the time to make sure that they feel like they've done their research and not just been presented with, it does happen, I suppose, a product that's best for the broker or the quickest for the broker, not the best for the customer. So, if they were going to come to you at Me Financial, Marc, and obviously get the best advice, what kind of questions would you expect someone to ask?
Well, I think that really boils down to the circumstance that we mentioned earlier. So very, very often, the best rate for you won't be the best, lowest interest rate. There's a few factors. And I suppose if you're doing your research for yourself on a comparison side or anything like that, you may be able to find a very, very low rate, but there may be fees. So for example, there could be a product fee. So the general highest product fee on the market now for a residential mortgage is about £1,499. Okay. Now, are you going to get that £1,499 by having a interest rate that's 0.1 lower than the one that only has a £999 fee? So we would do all that maths for you and work it all out. But if I was looking at it for myself, that's one thing that you would factor in, the pounds versus pence. Am I going to get my money back by paying a bigger fee or not? So that's the first thing you really need to look at. And your circumstances. Your circumstances are fundamentally the main reason that a mortgage broker would recommend a rate that wasn't the lowest on the market. Now, don't get me wrong, it might not be completely terrible, but I'll give you once again a real life example here. One particular lender, be it Halifax, they're particularly good with construction industry schemes. So people that are paid with CIS vouchers, for example, at this moment in time, might change tomorrow, who knows. But that lender may mean that they could borrow an extra £50,000 just by the way that they're paid compared to someone who's slightly cheaper that doesn't assess things in that particular way. I would say that's probably one of the most common areas that will dictate why you would choose a slightly higher interest rate than the very bog standard. Because as you said earlier on in a video before, why are there lenders that lend different amounts? Your circumstances, as I say. You might find that one lender's not good with the amount of debt you've got, but another lender is. You might find that some lenders aren't very good with the type of property you're buying as well sometimes. Is it opposite a pub, or is it opposite, I don't know, a massive planning thing that's going to happen or anything like that? There's all these different variables that would affect the product that we look for. But bringing it back to basics, I would say the fee that you're paying for that particular product, other benefits that are included as well. So some lenders offer cash back. For example, they might give you up to £1,000 plus for cash back for going with them. So we would go, although that one's slightly higher, they're going to give you £1,000 within 28 days of you completing on your home. That could be great for you. First time buyer, that could be paying for a sofa that you don't need to get on finance. It's going to impact the amount that you're going to borrow, anything like that. So all of these different factors build up.
Yeah. Okay. And then I think what you've done for me personally in the past as well, Mark, you said, well, let's take this 3-year product here with let's say £1,000 fee, today's rate, 4.5% or whatever. And you've actually calculated the monthly payments plus the fee and looked at what the total spend is over the 3 years. And then on the reverse, I've gone, well, I can find you one at a cheaper rate, but it's got a higher fee. Let's work that out. And actually, quite often you're surprised that the higher rate with the lower fee probably works out cheaper over 3 or 5 years. So I think doing that over the repayment, including the fees and any incentives that are available, is a really important thing to do, I'd say, and a good exercise to go through with your broker, or even, on your own, doing some homework before you put pen to paper. The other thing I think maybe in terms of deposits we didn't cover earlier, maybe just to go back to, it's just come to me, but a lot of new home development sites at the moment, because obviously the market's not been great over the last kind of 12 months, I've started seeing a lot of vendor gifted deposits coming back, whether that be 5% or other incentives such as stamp duty paid, etc., or moving costs paid or whatever. How does that affect the mortgage if the developer is genuinely saying we're going to gift a 5% vendor gifted deposit or developer gifted deposit? How does that work? And again, do certain lenders turn the nose at it, and the specialist lenders that prefer it?
Yeah, I wouldn't say necessarily specialists to access that sort of thing, but in principle, how it works is, let's say that one we've spoken about before, let's say the vendor's giving you a 5% incentive to buy that property. Okay. Depending on the terminology, it's either a vendor gifted deposit, a concessionary purchase, or anything like that. But they're giving you something to do it as an incentive, basically. Now, how that works is generally you'll still have to put something in, and it's normally 5% from yourself, which if you've got 5% deposit and that's going to turn into 10% deposit, that potentially gives you better rates available because you're going from a smaller deposit to a bigger deposit. And lenders are generally all right with that. What they're not all right with is where if a vendor or a builder ever says, oh, we're going to give you loads and we're going to discount it, which if you find one, go for it, because I don't think that's going to be the case that they're going to give you, 50% deposit, which would be amazing. But the amount of deposit basically what you can put in can't exceed what they're giving you. So you normally have to match what they're giving you. It just means that the rates are slightly better, so they will use that. Now, things like stamp duty incentives and stuff like that, there are lenders that are okay with that as well. They consider it in a sort of similar way, but I think that it's more common that you'll get a deposit contribution towards what you're buying now, because I think a lot of builders know that when you've got a nice, brand new, beautiful home to sell, it's going to help people get on the ladder, and that's generally how it will work. So yeah. Is that answered enough? Have I covered that?
Yeah, I think so. Yeah. I suppose it's these kind of things that are out there in the market, but I suppose not everybody has dealt with before or come across. Vendor gifted deposits back in my early career in agency used to be a massive thing. But then I think after the kind of financial crisis in kind of 07, 08, they just disappeared overnight and were never seen again. And my understanding was that lenders just didn't like that because they felt that the price was being inflated just to create a deposit and other factors. For many years, we just said it's not a thing, but lenders' appetite to that, I think, has changed over the last few years, and possibly, again, enabled developers and sellers to open that back up to the market, where before it just wasn't a choice.
I I think lenders are acutely aware of that as well. I mean, although generally speaking, a new build property is going to be built to the sort of area and the price based on what's around and everything like that, it's a little bit of an unknown quantity if you're buying a new build, because how's that going to settle? What's going to happen in the area and everything like that. And I think that's why lenders want you to put in a contribution, say of 5%, because you're at least got some skin in the game as well. So if the property is up to 5% overinflated, you've still put money in, but the lender's allowing you to benefit from that deposit still that the vendor's gifting you. So it's a bit win-win from that perspective in terms of the rate that you've got available. But yeah, just as a buyer, you want to make sure what you're buying is right for you and the one you want to go for.
Yeah. Okay, brilliant. We've covered it off a little bit earlier, but in terms of what it really costs, what people can expect as part of the journey in terms of arrangement fees, valuation fees, obviously increased, as you said earlier, valuation fees or valuation is the minimum entry. You can then kind of upgrade that to home buyers reports and higher degree of surveys and valuations. If you could kind of, again, for a first time buyer saying, look, we're going to buy this year, if you could kind of get them to understand all the costs that they're probably going to be faced. And then there's a little bit around, I know some costs can be added to the mortgage, some can't. So maybe a bit of explanation around that.
Yeah. Okay. So in terms of the fees you can add there, that's probably a good place to start. So we mentioned earlier on about the arrangement fee. Some lenders call it a booking fee as well. It's a fee for that product, basically. So if it's 999 or 1499, generally speaking, lenders will allow you to add it to the loan. Your mortgage broker or your mortgage advisor, if you go directly to the bank, will have that conversation with you. The downside of adding the fee to the loan is you pay interest on it. You pay interest on it potentially for 25 to 35 years on the term of your mortgage. But, getting on the ladder sometimes needs must. That £1,500 potentially will be great going towards, something that you want to do or your deposit even. So that's the first thing. So you can add those, yes. For first-time buyers especially, though, often there's lots of no-fee options. So the lenders will have options with no fees. Talking about the valuations, so we said the bare minimum you have to have is a mortgage survey. Some might call it a level 1 or whatever. That survey is purely to understand, as I said earlier, that it's worth what it's worth. It's really for the lender. Very often, you won't even see that yourself, and you'll only know it's happened, or you'll only get feedback on it if there's a problem. So they say, it's not worth that. What are you going to do, Mark? And then we'll have a conversation. So I would not rely on that for anything else apart from you getting the mortgage, really. They're often free, certainly with a first-time buyer, but they're often free. They may be around the 1 to 250 mark. But as I say, once again, talking about what you're looking around on the market for, you want to look for lenders that don't have all these add-ons and stuff like that, which will help you navigate. If you wanted a more comprehensive, there is a level 2 or a home buyers report, as you said. That is effectively the easiest way for me to explain it is it's like a traffic light system and all the different aspects of the property. So they'll go, this room, you might want to sort this out. You might want to sort this out. They'll give you lots of red, amber, greens of all the different bits of the property. And then you've got a sort of comprehensive report based on all the different rooms and everything like that. Now, my advice will be, I would probably say, every single first-time buyer that gets that phones me up going, this house is rubbish. This house is useless. There's loads of things wrong with it and everything like that. Yeah. I'm not saying, you shouldn't pull it apart and everything like that, but houses generally have been lived in. Regulation has moved on. So electrics is a massive one. So sometimes they go, we would 100% recommend you get your electrics changed, or the electrics are red because they're in the old style regulation. Exactly right. So I would take it with a pinch of salt, but if you do want to do these sorts of works, you have to factor that into a budget of things that you're going to need to put money aside for and pay for. So this is the sort of things where if you have got a deal that's got cash back, that could potentially be something to look at. Generally speaking, I would say you're looking in the ballpark of £400 to £600 for that. Some lenders will allow you to upgrade your valuation to a home buyers, not free. They'll give you a tiered sort of pricing. My only stipulation for this, and if my compliance are listening, I'm not doing anything wrong in saying this, but if you're buying a home, would you want the lender to have sight of the valuation report before you have sight of it? Because there might be a problem that's highlighted that's not necessarily wouldn't have been highlighted in the first place. Clearly, this report is for you, and it's for you to make sure that you're doing the right thing. But often it's good to have that control over the report. So for the right scenario, I would potentially consider your own independent.
Privately.
Yeah.
just do the standard valuation for the lender.
Quite possibly, yeah.
I really liked when the new version, I say new version, it's probably more than 15 years old now, but when the home buyers reports changed to that traffic light system, because previously, it was a really heavy document, very jargon led, very technical. I felt as an agent and two as a purchaser that's, has no idea about property maintenance or electricals or gas installations or boilers. It was a minefield, where at least now it's like each section, and it literally is as simple as a green, amber, red. Red is something that needs urgent attention. Amber is a recommendation. You'll probably correct me on this, Mark, and green obviously is satisfactory. So, for me, when I see one of those, it's a lot easier to digest now, and actually easier to explain to people that although there's a lot of ambers, you are buying a property that's 100 years old, let's say, which a lot of the UK properties is at that old now. It's not going to be perfect. If you were buying a new build, you'd be seeing a lot more green. And ambers are recommendations. Relations change almost every 12 to 24 months in the world of electrical and gas safety and whatnot. There are things, as you've said, you need to take with a pinch of salt, and you need to have a commercial view on it. It's not necessarily you can wave that in front of the agent and say, I want a reduction on the price, because these are things that, it's like buying a second-hand car, isn't it? It's got a scratch on it, or, something's not quite working on the sat nav or something. You're not buying something pristine off the forecourt that's come out the factory, same as a new home. So you've got to take that with a bit of a realistic approach, I think.
Yeah, I completely agree. I mean, a lot of buyers don't know what questions to ask. And I think that report is giving you the questions to ask. Yeah.
Okay, perfect. Then there's a little bit around, people ask, well, how are my repayments calculated? So you're taking a 25-year term, let's say, or a 35-year term. You're taking a 5-year fixed product at the start. Let's just say, for argument's sake, the repayment is £1,000 a month that's been quoted. How have they arrived at that repayment structure for that fixed period? And what happens after the fixed period ends? And if you weren't to kind of jump to another fixed rate product via a remortgage?
Yeah. Okay. So whenever you take a mortgage out, you'll have something called a mortgage illustration, or an ESIS document. Basically, it's a illustration that's in the same format with every single mortgage company you go to. It has to be legally in the same format. Okay. You'll be looking through that document and you'll see a lot of shocking numbers that will scare you, which I'll come on to in a minute. But to answer your question around that, yes, your initial period, it'll say, let's say you've got a 4.5% interest rate for the first 24 months, and that would be £1,200 a month or whatever that might be. Then after that time, it will jump up when you go on to the standard variable rate, which is the current rate at that particular time. So that might be subject to change. And obviously, your initial rate, if you choose a variable rate, it also could be subject to change as well. But you'll have that initial rate that you've got there, and then it will jump to that if everything stays the same. Okay. So you'll have the payment on that, and then the payment on the standard variable rate. Now, there's a page in the illustration which talks about an APRC. So if anyone's ever done some sort of looking around at finance and everything like that about an APR, certainly when you're buying a car, people say, oh, don't look at the interest rate, look at the APR. It's sort of a bit different for mortgages. Your APRC, right, will be something like, it might be 6.7% or anything like that. And the amount of buyers I've had come to me that have said, hold on a second, Mark, you said this was 4.5%, and look, it's 7% on here. It's because the APRC is the figure of the true cost of the borrowing over the full term of the mortgage. So if you had a 25-year mortgage, right, and you had, for the first 2 years, you're on 4 point whatever, and then for the remaining 23 years, you were going to be on, say, 6.5%. It's the average percentage rate over that period of time, as a very rough calculation from in my brain. That's generally how it works. And you'll also see a depressing total amount payable figure there as well. So somebody who's borrowing, say, 150,000 quid might say, yeah, the total amount payable is 500,000 quid or something at the end. It's only if you did nothing at the end of the 2 years. Now, I'm not trying to skirt around it. You're going to pay a lot of interest over 25 years, even if you were fixed for the full term. But those figures aren't anything necessarily to worry about. You just have to make sure that you plan. So when you get to the end of these sort of 6 months before your deal ending, have another chat. Hopefully we'll be in touch again, or whoever you sorted out the mortgage with, have another chat, see what's available, have a little look at what your plans are, have your circumstances changed, then get the advice base. So when that mortgage deal comes to an end, you've got something in place to replace it. Then the whole cycle starts again.
Yeah. Okay, brilliant. A section then on self-employed, I think, is a good place to be, or a good topic for us to cover.
My favourite.
Me personally. Yeah, I've got a lot of friends and family that's self-employed, tradesmen, that kind of stuff. There's always been a bit of skepticism or criteria around maybe, you need to have so many years worth of books and credit score and all that kind of stuff. So maybe could you talk to us if I was coming to you as a first time buyer that's self-employed, what are some of the minimum things I'm going to need to be able to provide and suffice the lender?
Okay. It's very hot at the moment, and I'm going to talk in ice cream flavors in terms of the vanilla. Okay. So,
Right.
so we've got the standard is most lenders will require an average of the last 2 years figures. When I say figures, the figures change depending on how you're set up as self-employed, right? Let's start from the beginning. If you're a sole trader, okay, the standard is if you're a sole trader, you'll have something called a tax computation, formerly known as an SA 302. Okay, that will show you what your taxable income figure is. So your income from self-employment is literally what it's going to be called. If you're anything like lots of the self-employeds I look after, accountant sorts that all out and they go, there you go, you're paying 25 grand, you've earned £25,000 this year, and there's your tax bill. And we all go and panic and work out how we're going to pay that. So all joking aside, we've obviously planned. So basically that figure is the figure that you would be working on. Now, you may have financial accounts. So if you're a sole trader, you may have financial accounts. You might have contractors that work under you. So you've got a full set of accounts. But that bottom line, that net profit figure is generally what's going to show on your tax computation or your SA 302 figure. Okay. So the average of the last 2 years. I'll come back to how it's assessed in a second because it's a bit different for partnerships. Similar thing with partnerships. So if you're in a partnership business, you may be a dentist or something like that. A basic partnership, you might be an LLP if you're a dentist. So let's choose a different one. Any sort of partnership basically doesn't matter. So you've got a business partner in a electrician's company or something like that. If you're a 50-50 partner, you're going to have the same sorts of figures. So you're going to have the profit that partner A's earned and their proportion of that profit and profit of partner B. You will most likely have financial accounts as well for that because you'll have a more complicated scenario where they're going to work out, what bills you've had come out, then which partner's getting which bit of income. But effectively, your figures that are produced are going to be the same. So your net profit each or your profit from self-employment that you're going to be paid tax on. Limited companies are also a tricky one for people to get around sometimes. This is probably the biggest area that people have a misconception about when we're helping clients who are owners of their own limited company. Okay. The reason for that is that sometimes people get bad advice saying that I own my limited company, so I'm not employed. So I'm employed. So I'm not self-employed. I own my limited company, so I'm not self-employed. That is incorrect from a lender's point of view. It might be okay from an accountant's point of view and a tax point of view, because as a director, you would have a salary and then you're likely going to take a dividend, pay yourself a dividend from the profits of the business. That will add up to what your figures would normally be taken. So your salary and your dividends. So that'll be on your tax calculation or your SA 302s, like we said before. So you'll have what your salary is from employment. Weirdly, it's always £12,750 or something in that sort of space, which is the minimum you can pay yourself as a director. Then after that, you'll have a dividend payment. Okay. Now, why I'm saying that is if you own more than 20% or 25%, depending on the lender of that limited company, they will consider you as self-employed anyway, because you're effectively the master of your own universe. So you basically own that company. You make all the decisions of the business and everything like that. Lenders aren't stupid. They know that you might go and pay yourself £8,000 a month more in the 3 months leading up to you applying for the mortgage. And they know that that's not the case. I've had so many cases where they've had wrong advice from maybe the wrong type of accountant or an accountant that just doesn't know about mortgages. They know about tax, and they think just paying yourself 3 months increased salary before you're applying for a mortgage will show you 3 months pay slips. There you go, Mark. You can lend me lots more money now. It doesn't work like that. The only other variation with with limited companies is some lenders will take the net profit of the business and directors' remunerations, which is effectively what you're paying yourself as a salary. They'll take those figures as well. Now, that would be the advice from me. Whichever one's higher will dictate who we generally go to for your mortgage. So you might get one lender that takes salary and net profits, and you might get one lender that takes salary plus dividends. if one's higher than the other, that normally will dictate which direction we go. To bring it all back around, those 2 years accounts is the vanilla in terms of what lenders will take. Okay. So it's an average of the last 2 years. Okay. So if there's a downwards trend, so the previous year you had a super bumper year, and then the current year you had a drop, often the lenders will take the lowest of the most recent of the 2 years. So we might need an explanation from the accountant to say what that's all about. But if there's an upwards trend, and they'll generally average them over the last 2 years.
Right.
Make sense? The only other variation to that is some lenders do take 1 year's accounts. There are a lot of lenders that take 1 year's figures. Okay. So depending on the circumstances, they'll take the latest year's figures. A really good example of this is we're doing a mortgage at the moment for a client who's just gone self-employed, or she went self-employed a year or so ago. We've only got 1 year's figures because of that, but she was in the same line of business as she's always been. So she's carried on the same job. She's done great at that job. Now she's doing this job as a business, and she's been going for a year. A lot of lenders will take that 1 year's figures if you're in the same line of business. That's something to consider as well.
Don't rule it out if you haven't got 2 years books. There are lenders that, but obviously minimum of one. Right?
Definitely. Yeah, definitely. You definitely need 1 year. Now on this CIS contractor part, okay, so that's the major fundamental change, right? So a lot of contractors in the CIS scheme, it's an area I do a lot of. A lot of lenders will consider them as being employed, even though they may get paid self-employed. So if you're a self-employed contractor, if you're a CIS contractor, you're going to get your pay stubs weekly or whatever that might be. You'll put that into your limited company, and then you'll have a tax return. You normally claim back your materials or whatever you've paid, and you'll have your tax bill at the end. But normally you get 20% deducted from your contract at source, from your pay stub at source. There's a lot of lenders that would actually accept you on a contractor basis, and they might take, say, 48 weeks of your gross pay, or 46 weeks, depending on the lender. And that will often allow you to borrow a lot more and not have that restriction for self-employed. So if you are a tradesman or anything like that, and you think, well, actually, I am paid like that, I don't realize I'm paid like that because my accountant just sorts it out, have a conversation. Yeah. I would say most CIS contractors don't know that they're paid like that, and they just give the stubs to the accountant. The accountant sorts it. It's a big area for us that we do a lot of, or other lenders.
Okay. Yeah. Brilliant. So I think there's a lot of variables to a self-employed application, but yeah, minimum 1 year's books, 2 preferable. I think have a chat with a mortgage broker or someone like yourself, Marc, ahead of time, I suppose, is the key thing, right? To make sure that you are thinking of buying a property, that is a prime example where you definitely need to speak to a broker first before going out and looking at property.
Exactly right. And as a business, you might have a expense lined up. So you might want to buy a van or something like that, and it's a one-off expense. You may change your mind if that's going to impact on what your profits are. You may decide to put that back to another year or something like that. So there's all these variables you have to get ahead of time. The problem with self-employed, where mortgage lending is concerned, is your latest set of accounts normally can't be more than 18 months old. And that's ages ago. So if they're more than 18 months old, the lender will ask for your most latest figures. And there's this weird window where you might not have done your figures yet because you've got from 9 months to from your year end, but the lender wants you to have them. So getting ahead of it and speaking to a mortgage broker or anybody ahead of time is vital.
Is key. Yeah, brilliant. Okay, Marc, where can people get in touch with you if they want to find more information or get in touch with you guys to have a conversation?
Yep. So we've got lots of handy tools and contact forms. So just a little bit of a summary of us. That we're a team of 8 at the moment, plus an admin. We've got a pool of people all over the West Midlands. I'm based in the Solihull area, but I cover most of Birmingham and it feels like the most of the UK, to be honest. We've got people as far down as Reading. Generally speaking, lots of availability, depending on what your circumstances are. We do home visits, we can do Teams calls, we can do phone calls, any sort of flexibility you need, we're hopefully there. Me Financial Services, E as in me, financial.co.uk. So if you search for Me Financial Services on Google or go to mefinancial.co.uk, there's lots of great information on there. We even have lender-backed affordability calculations. So if you just want to find out how much you can borrow and what that would cost you based on your specific circumstances, you can put in all details about your debts and everything like that in there. It will give you a fairly accurate figure straight from a pool of about 50 lenders. But yeah, brilliant. Reach out. Thanks. That's perfect.
Yeah, definitely. Yeah, so if anybody's got any questions, please feel free to get a hold of anyone at the Miller Rose team. We'll happily put you in touch with Marc, or obviously Marc's just given you his website there. Feel free to go direct. So Marc, thanks for your time today. We've covered a lot. Hopefully it's been useful, and look forward to the next one.
Thanks everyone. Cheers, Andy.